Hi, this is Greg McIntyre at McIntyre Elder Law, and I'm with Ryan Begley with McIntyre Financial, the financial side of the house. And today we're going to talk about Be Your Own Bank, which has been a huge hot topic. And I've done some videos. I know Ryan has been talking about this. So we're going to break down what exactly we mean, aside from the flashy term Be Your Own Bank. Ryan, when we say Be Your Own Bank, you using life insurance products and potentially a trust to
Mhm.
house those life insurance products, which would allow you to potentially have generational wealth using those products. Let's start with the basics and just talk about that concept of Be Your Own Bank and how life insurance allows you to do that.
Well, instead of putting your assets in a savings account that yields little to no return, you're going to put your assets into a life insurance policy or life insurance product or an insurance product in general that will give you more returns than yield you more returns than a savings account will, right? And then now, if it's structured properly, you can take loans out on it, and then you can pay those loans back to your own insurance policy, and you're still getting that compound interest. And that's what makes it advantageous for individuals to get this, because your money is not just treading water. So it's not being stalemated. It's actually growing for you, and even if you borrow against it, it's still going to grow for you. And then also you put that, furthermore, you put that into a trust, and then that protects it from the outside world.
So let's talk about just the insurance policy and the concept of borrowing from the insurance policy first.
Mm-hmm.
I just want to make sure I fully understand it, right? And we flush it out. So let's say I have a policy that has $100,000 death benefit. It could have a $500,000, $1 million death benefit. Can I
Mm-hmm.
borrow from that policy?
Yes. If your carrier has it structured that way, yes, you can. So
Okay.
like most of the stuff, that's why, like we've said before, I'm a broker, not a just a single insurance agent, a captive agent. So I don't sell for just one insurance company, because I go find the insurance carrier that's best for my clients. And when I do that, it's really great, because sometimes they don't want to borrow money from their insurance policy. They just want a high death benefit and a low, monthly rate, or they want a high cash value to where they can build that cash value up, borrow against that cash value, and do it that way. And then what's great about it is if you don't pay that cash value back, like let's say you take out a loan against the cash value of your policy, and you don't
Terms of this loan. That's important to me. I mean,
okay.
yeah, what's the terms of the loan? If I have, let's say, a $250,000 death benefit, if I borrow $50,000 and I'm going to use that in some way.
Yeah. So
what are my payback terms? What's my interest rate and what are the payback terms?
your interest rate, it depends on the carrier, but it's much lower, usually much lower than a bank.
Okay.
And then also,
so kinder terms, probably a traditional bank, right?
Yeah, of course. And one of the great things about it, it's very quick. It's only a few phone calls, and no credit report, no credit history, and no credit. They don't talk to the credit, company.
So it's going to be quicker. It's going to be easier for me to do, regardless of credit rating. And what are my, the bank, when I borrow money, they might say on a commercial property, for example, and I have experience doing that. I'm going to work out terms on the interest rate, and then they're going to tell me, whether I work out variable or fixed terms. Okay. They're going to tell me, hey, you owe X number of dollars per month every month. Is that the same deal with the insurance company? Do I have to pay back every month on a certain day of the month, or
not normally,
something like that? How are those payback terms set up? Schedules.
So it's on your own term. It's on your own schedule. The reason why it's on your own schedule, because if you don't pay it back, they're just going to take it out of your death benefit.
Okay. So they know they're going to get paid back regardless. Plus,
exactly.
Right?
Yes.
So that's the deal, and where the insurance company is in a good position there. But you're also in a really good position, and this is why it's attractive to me. And this is why I want you to get with me, to teach me how to do this, and let's set this up for myself. Okay.
Mm.
Please schedule that consult with me. All right. Because I would like to do that. I would use it. It's going to allow me to say, if I have a property that I want to buy, borrow that 50, right? And if that's 20% down, 30% down, I may have a traditional loan that goes along with that to be able to buy a piece of property. Virtually no money down. And then once I've got that piece of property and rents are coming in, that property's cash flowing, I can direct that cash flow into that insurance account that to pay back that loan on the insurance proceeds if I want to, and square that away with the insurance company. If not, the insurance company doesn't care. They're okay with that, because my death benefit, if I decide to leave us, right, and move on to the next level, then it pays off my loan. Correct?
That's exactly right. And also, a lot of people don't understand. They think of a loan on the insurance companies like a loan in the bank, but it's not. So you're borrowing against your policy, but you're not taking money from your policy. So technically, if you have $100,000 in your life insurance and you take money out on that $100,000, there you're still getting compound interest on that $100,000.
Mm-hmm.
So that loan, you still you don't just, it doesn't go with you, it's still there. So you're still getting that compound interest. You're still getting, still getting those rates of return. So when you do have to pay back that loan, or let's say you want to pay back the loan, so you're paying back that loan on a schedule and you're paying some interest rates, you're also that growth is cutting into those interest rates for you.
Mm-hmm.
So that's what's amazing to me. Also, if you do it into indexed life insurance, where it's indexed to the SPN 500, then
and this is if I'm contributing a whole life or partial whole life policy that has cash value, I'm putting money into that policy, right?
Yeah.
Okay. That's what's compounding. That's what's building, right?
Yeah.
And you were going to say something about an index fund.
So the index, when it's yeah, you take all these advantages on the upside, but none of the disadvantages, because they always have a floor.
So the markets are going to go wherever the markets are going to go, up or down, right?
Yeah.
If I have it in the stock market, right?
Yes.
But an index, if this is the low of the stock market this year and this is the high, I can set a floor of, say, right here, and I don't want to go below that. And that's the deal that I make with the insurance company, where I can ride the market up and get a higher rate of return. But then if the market goes down below the floor, my rate of return stays at wherever I set that floor. It doesn't follow that below the floor, right?
Yep. That's exactly right.
So that's a really secure way to set up investments, especially if you're tired of volatile markets.
Yeah, if you want to have that protection and understand and know where your money's going and what it's going to do for you, they can project an average rate of, for 10 to 30 years, you know what I mean? And they can give you the back rates and all that stuff of what the market has done. So it's really cool. And then also, most of these products have a death benefit rider on them. So accelerated death benefit rider that helps you pay for long-term care and helps you pay for if you get an illness, like let's say you do get cancer, you can use a portion of your death benefit right then to help you through that hard time and your family.
So we can kill 3 birds with one stone.
Yeah.
3 birds with one stone with a product like this.
Mm-hmm.
We can borrow against it, have kind terms, pay back as we feel like, or have it taken for the death benefit. We can have a haven or a shelter from volatile markets by putting money that we otherwise have invested in the market into a product that's an index product, so that I don't suffer the valleys. I take advantage of the peaks of the market, but I don't have to bear the valleys. Okay. And then the third, I can also help pay for long-term care, right? using that product. Now,
That's
Ryan,
exactly.
is there some type of multiplier in there where if you have a long-term care rider on that, that it will pay off more than the principal you contributed for long-term care?
Oh yeah. It'll give you. It'll actually tell you on the projection, like when we sit down and do a quote, it'll tell you on the illustration how much, and depends on which policy you get, of course, but it'll tell you how much exactly that is going to go to that long-term care.
Sure.
And it's going to look it's going to look great. I know because I just did I did a quote for a young lady the other day, and I was impressed. I looked at it, I was like, dang, this is awesome. Because
Sure.
I'm always running these quotes constantly, and then when I see a one that's super awesome, I was like, wow, I just want to like talk about this one because it's super exciting to me because it helps a lot of people.
Okay. Well, I'm super interested in it. Promise me coming out of this meeting, you're going to set on something on my calendar so that we can do an interview for me. Okay.
Yeah, of
Because
course. I think that'd be
interested
awesome.
in that, and would like to get that going. All right. And hey, if anybody else out there, we talked about using a trust. If you wanted to really take this to the next level on the legal side, what I would do is set up a trust that would own that policy or multiple policies, and where you can borrow from that policy and it be in the protective environment of the trust. You can also have beneficiaries on, if the trust owns the policy, on the trust, that can also have access to borrow as well. And then at your passing, it pays off all that debt and funds the trust with the excess. And that is a way, if you keep doing that and you're strategic at that, that can carry you and your family for a long time if you look at a plan like that. If you're interested in estate planning for asset preservation and maximizing your retirement benefits, I would ask you to consider using, how about estate planning? Okay. Number one, and then looking at Ryan, can help you with the insurance side of things, and considering that as insurance as being one of the most trusted investments out there. Wouldn't you agree, Ryan?
I would absolutely agree. And also, I just wanted to point out this one thing because I think it's super awesome. This blew my mind almost when I ran these numbers. So you have, I had this individual want me to run a quote on a $1 million policy for annuity, indexed annuity for 30 years.
Mm-hmm.
That will pay them out for 30 years around $5,400 and something dollars. And it comes out after that 30 years,
A month?
$1.9 million.
A month?
Yes.
So if I put, how much do I have to commit? If I committed $1 million,
yes,
then I'm going to make 1.9 million off that, right?
Yes.
So that would be, 300%, right? Is what I'd have back. Okay.
Well, it's just amazing. Like if I had $2 million right now, I would throw one of those in the
That's a guaranteed plan, right? That's a guaranteed plan.
Yeah, that's a guaranteed plan with a beneficiary as well.
Right. So that's, you want to talk about setting yourself up well over time and maximizing what you save for retirement. Something like that is a great option. I love that.
Yeah, because after 30 years, with inflation and everything like that, it's not going to be $1 million anymore after 30 years. So this helps, the inflation, the value of the dollar. It just helps, help that burn a little bit.
It is a hedge against inflation.
Yes.
And also, a guaranteed insured product that, that you're contractually bound to get, and an alternative to simply weathering the storms of the market, which is huge right now. The stock market has had its worst, finished up the worst half of a year, since I want to say it's since the 1800, late 1800s, something ridiculous like that. Okay. It's been a horrible year in the market. And if you had your money in retirement in something like this, it would be insulated from that. So that's huge. Okay. So I appreciate you being with us today on the McIntyre Financial Report today, Ryan.
Yes, sir.
And, I need you to help me schedule that appointment. Okay.
I would be happy to.
My wheels are already turning. I already know some things I want to do. All right.
Awesome.
See you, man.
See you.